Good afternoon. You're watching Business World Live here on One News. I'm Jess De Los Santos. Let's take a look at how the local bourse closed today, Wednesday. All right, you have the main index on correction mode today. This is shares knocked down by 0.9% to 7,357. This halts a 6-day rally, which saw the local bourse reach a pandemic high of 7,400, its highest close yet since February 2020. The retreat just comes a day after the economy grew 7.1% in the third quarter, beating expectations. It also pushes us closer to reaching full year growth targets and what Neta says is a possibility of reaching pre pandemic growth level by the first quarter of 2022. Now, despite the sell off, though, you have offshore investors still continuing to shop for local stocks here. That's for a fifth straight day with purchases at 517.3 million pesos. Decliners beat advancers with only a handful of stocks ending the day in the green. LT Group is the day's biggest drag. BP, as you can see, down by over 5% here. BPI likewise also ending the day in the red, down by 4%. But let's dwell on this one blue chip here. I'm talking about Metro Pacific, which just released earnings report for the third quarter. You have third quarter net income up by 44% to 3.5 billion pesos. That pushes 9-month net core net income rather higher by 23% to 9.5 billion pesos. Profit bolstered really by the impact of the Create Law, which lowered tax rates. You also have net income for various units growing for the July to September period for Meralco. That's an increase of 30% due to better energy sales growth. At the same time, Maynilad posting a 4% increase in net income due to lower taxes still from Create, and its toll business unit also increasing by 17% due to higher traffic. Now, according to Chairman Manny V. Pangilinan, 2022 should be a better year for the company with prospects of economic recovery. They are also focusing on exploring opportunities in the digital space here. Not much love, however, for Metro Pacific, at least on today's trade here. You have Metro Pacific ending the day flat at 4 pesos and 2 centavos a piece. Here are other headlines we're keeping our eyes on. More than 40 million Filipinos have completed their Step 2 registration for the Philippine Identification System, or PhilSys. This phase involves the verification of the registrant's demographic information, as well as the capturing of their biometric data like fingerprints and iris scans. This brings the government closer to its goal of registering at least 50 million Filipinos into PhilSys by the end of the year. Deputy National Statistician Rosalinda Bautista tells One News's agenda that they are also eyeing to reach at least 90 million registrants before the end of President Duterte's term. She is, however, calling for the public's patience for the delivery of physical IDs, as the PhilPost only has the capacity to deliver up to 80,000 per day. Bautista says the PSA is now eyeing to launch a mobile ID in lieu of the delayed physical ID cards fulfilled PhilSys. Now, as traffic in NCR nears a return to pre-pandemic level, the MMDA is considering reimposing the number coding scheme. Authorities attribute the heavier traffic in Metro to the increased mobility under Alert Level 2. With this, the MMDA wants to reimpose the number coding scheme, but only during rush hours from 7 a.m. to 9 a.m. and 5 p.m. to 7 p.m. Transport groups are now asking the government to allow 100% passenger capacity in PUVs, as the possible reimplementation of the scheme translates to higher ridership in public transportation. Now, Fitch Solutions has revised its growth forecast for the Philippine economy. That's amid the gradual relaxing of mobility restrictions in the country. Fitch Solutions now forecasts the Philippine economy to grow by 4.5% in 2021, up from the earlier projection of 4.2%. However, the 2022 growth outlook is seeing a downward revision from 6.8% to 6.5%. So just what pushed them to make that upward revision for this year at least? Let's go straight to the source. Michael Langham, Senior Associate Country Risk Analyst over at Fitch Solutions. We talked to him straight from Singapore. Good afternoon, Michael.
Hi, and thanks for having me back on.
All right, of course, it's our pleasure. Now, third quarter GDP at 7.1%. Was that a surprise for you?
I think it was a surprise to the upside when you look at the Q-on-Q growth that actually surprised to the upside from a contraction in the last quarter Q-on-Q to strong growth this quarter Q-on-Q. And that was because the economy is normalizing, I think, at a faster pace than many people had priced in. So that's really what drove our revision upwards for this year. The fact that we've seen evidence of normalizing activity at a sooner pace than we had considered. So when you look at things like mobility data or the traffic data, as you mentioned, there's clearly signs that the economy is getting back on track, and particularly given the Philippine economy's dependency on domestic activity to drive growth, that's quite a big change and led us to revise up our 2021 outlook.
Okay, given that, how are things looking up at least for the fourth quarter based on how things are developing here?
Yeah, the fourth quarter, we expect activity to remain fairly strong. There will be that factor that, the re-loosening or the loosening of measures that occurred in Q3 won't play as big a part in driving growth in Q4, but we will see that return to confidence from relaxed measures, and generally activity beginning to pick up, particularly on the consumer side, which should boost economic activity more broadly. Other things like delayed projects and just generally the logistical side of things should improve, which allows economic activity to remain fairly healthy going through the Q4.
Mm-hmm. Now, question is, are there any downside risks here that we have to be keeping an eye on?
Yeah, there definitely are. I mean, the vaccination program has been ramped up in recent months, but there still remains that lack of vaccinations across certain parts of the country and regions where vaccination rates aren't as high as others. And that discrepancy does leave the economy vulnerable to outbreaks and potential disruptions to travel between regions. And we can't rule out some further disruptions from the pandemic. On the other side, there's the external factors that I think we have to be aware of. Financial markets have been becoming increasingly hawkish in recent weeks and months. And that again could tighten. We could see a tightening of external financing conditions, which ultimately weighs on investment sentiment and overall economic confidence.
Okay, Michael, also what's interesting to note here with your report is that you at least made a downward revision for 2022. What prompted you to reach that decision, at least?
Yeah, so we revised growth down from 6.8% to 6.5% in 2022. And there were three factors behind that. Firstly, just base effects. High growth this year will mean slightly lower growth next year from the base effects perspective, and that normalization playing out sooner than we had thought. The second point is monetary conditions. So we expect inflation to run a bit higher going into next year. And what that's doing is shrinking real wages. We haven't seen real wage growth return to pre-pandemic levels. And that's going to weigh on household consumption somewhat. So you're not going to see consumer spending as strong as it could potentially be if inflation wasn't running as elevated. Particularly commodity prices as well will have some impact on the imports bill. And then the third factor I'd note is some external headwinds. I mentioned them a bit earlier, but there's the external financing side of things. A stronger dollar, Fed hikes could result in some pressure on emerging market assets, which eventually translates into weaker investment and general impact on business sentiment. But then there's also the issue of slowing growth in China. A slowdown in Chinese growth has a knock-on effect for regional trade activity and generally prices and demand for goods, and that in turn would also, weigh on exports growth and general business optimism. So we see those three factors as slightly tempering that outlook, but we do expect the economy to pick up pace in 2022, as shown by our forecast.
Heard you correctly, Michael. You mentioned earlier that you expect inflation to remain elevated all the way to 2022. At what level do you see that happening? And do you think this would at least prompt an action from the central government? Or from the central bank?
Yeah, so inflation, we expect it to remain within or average within the target range, in the upper band of that target range next year, running just below 4% on average. What's driving that view? Well, higher energy prices. When you look at the CPI basket for the Philippines, it's quite exposed to higher transport costs, and we've seen the government talking about how to pass these on to consumers, but ultimately that will filter through into higher producer prices and likely pass on to consumers as demand begins to pick up. The other factor will be that the demand side is improving. This normalization on the retail side, but also just the shrinking of the output gap in the economy as well, should all provide some pressure on prices. This isn't all just supply side driven. You have to have the demand there as well. So once the demand begins to pick up, you see prices passed on, or rising costs, sorry, I should say, passed on to consumers more frequently. So that plays into our inflation view, and we have priced in an extra hike now in terms of our view for the BSP as well. Rather than 50 bips next year, we now price in 75 bips, and that again will have some tempering on credit growth as well, which should have some impact on the economy.
Mhm. Now, also, what's interesting, you have economic authorities here in the Philippines pointing out the possibility that we might see pre-pandemic growth levels as early as the first quarter. Do you subscribe to that? When do you see the Philippines returning to pre-pandemic growth?
Yeah, so the actual pace of growth and from a nominal basis, output we do see output returning to around pre-pandemic levels, but on a real output and inflation adjusted viewpoint, we don't see growth really output levels really returning to pre-pandemic levels until in the latter part of 2022. And as I mentioned, because inflation's running that bit hotter, import bills are going to be that bit higher. That will play a role in the economic recovery. So the other factor I think to flag here is that the Philippine economy has diverged from its pre-pandemic trend growth. So where it was heading before the pandemic hit, that will take longer to reconvene with, and really a lot depends around the reform momentum, the policies in place over the medium to long term, and what can be done to boost growth such that it returns to that trend level, because there are some impacts from the pandemic when you think about the healthcare impact, but also higher debt levels and weakened household balance sheets that will ultimately drag on growth over the medium term. So much more will be needed to be done on the policy side to shift the economy back to that strong trend growth that it was on before this pandemic hit.
Mhm. Now, lastly, Michael, before we let you go, things seem to be looking upbeat for the Philippines. How do we fare compared to our regional peers?
Yeah, so when you look across the region, particularly in Asia, the recovery hasn't been as strong as I think was initially expected at the turn of this year. COVID-19 outbreaks in other markets in the region, when you think of Vietnam, that went relatively untouched in 2020, has seen a big outbreak in 2021. Malaysia's had recurrent outbreaks, and Indonesia, Thailand as well have all struggled. So the recovery rate has been delayed somewhat until 2022. We do generally see Philippines as a faster growing economy. It was pre-pandemic, and I don't think that's necessarily going to change. When we talk to clients as well, it's generally felt that the Philippines is still a fast growing economy in terms of that outlook. But what we do flag is that other countries within the region have higher vaccination rates, and that could make them less vulnerable to certain outbreaks or changes in vaccine efficacy. So we do think that the Philippines still remains somewhat vulnerable, similar to Indonesia and Vietnam in that sense, to COVID-19, more so than, say, Malaysia and Thailand. And that does pose somewhat of a bigger risk to the Philippine economy than maybe the others.
All right, it seems as though we're not really out of the woods just yet, even though, of course, things are looking good for the country so far this year. Thank you very much for your time this afternoon, Michael Langham, Senior Asia Country Risk Analyst over at Fitch Solutions. Thank you, Michael.
Thanks for having me on.
And those are the biggest stories this trading day, November 10, 2021. Catch Business World live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jess De Los Santos, and we are One News. Mask on, wash hands, and stay safe, Philippines.